All right. So in this chapter, we're talking about flexible budgeting and standard costs. So I just want to give you a broad definition of a flexible budget, because we talked about a master budget in the previous chapter. It starts with sales, ends with our budgeted financial statements. And that's usually a fixed budget because those are based on one level of sales for one particular month. The problem is that it's supposed to be a budget, and sometimes there are differences simply because I produced more than what I expected to, or I sold more than what I expected to. I don't want that to be the reason why there's a difference between my budgeted numbers and my actual numbers. I want to investigate and drill down and say, okay, we were wasteful here, or we were not wasteful here, and that's why we ended up saving money. So in order to give me a better answer about that, we can create what's known as flexible budgets. Flexible budgets give me different numbers for varying levels of activity. So on a flexible budget, I'll have my costs for when I produce 10,000 units versus 11,000 units versus 15,000 units. But again, based on capacity. So when I say capacity, I mean the total number of units that we can produce. So my flexible budget could be at 80% of capacity, or 90% of capacity, or 100% of capacity. Let's see if my slides actually show me an example of a flexible budget. All right, this one is a fixed budget. It's based on me selling 10,000 units, but I actually sold 12. So I know my sales are going to be higher, and I know this because I sold more than what I plan to sell. But what if I operated at the 10,000 sales level unit, and then this number was different? Well, then did I increase my sales price? Did something happen? Or if the number was lower, were there coupons or discounts, or did I have sales returns and allowances? What happened? So the flexible budget will help me answer questions like that. So here's my flexible budget. On a flexible budget, I get to see my variable costs and my fixed costs for my different levels of sales. Now notice that generally my fixed costs here should be the same because I'm assuming I'm operating within the relevant range here. But my variable costs, because they do change with the level of activity, they should be changing with my varying levels of sales here. Now, we like the flexible budget, and even with a fixed budget, we like to determine the difference between the budgeted amount and the actual results so that we can investigate and drill down further and find out why we have these differences. These differences are known as variances. These variances can be favorable or unfavorable, and it really depends on whether or not I'm talking about an expense or a revenue. But let's look at it from an expense standpoint. When a variance is unfavorable, I spent more than what I plan to spend. When a variance is favorable, I spent less than what I planned to spend. So all these U's and all these F's, that just means favorable and unfavorable. Now, let's look at standard costing, because standard costing is something that we use in that flexible budgeting system, again, as a way to give us better numbers. So in a standard costing system, we develop preset budgeted figures based on our normal operating conditions, and those figures give us a starting point in terms of comparing that to our actual figures. It helps us drill down further, and it helps us determine, okay, did we spend more money because stuff cost more, or did we spend more money because we were inefficient or our employees took too long doing something? So with standard costing, we come up with predetermined or preset amounts for materials, labor, and overhead. But we're not just talking about prices here. We're talking about usage in terms of pounds of material. We're talking about efficiency in terms of how long it took our employees to work. So we're looking at hours. So, but basically these are divided, again, in terms of materials, labor, and overhead. We take these standard costs, or these preset budgeted amounts, we compare them to our actual to calculate our differences. Our differences are called variances, and we then try to explain those variances. So with materials, we have standards for price and we have standards for quantity. Labor, we have standards for, again, price, but really it's the rate or the hourly wage that we pay. And then we have time standards in terms of how long it should take our employees to finish the job. And then we have standards for variable overhead, again, in terms of that predetermined overhead rate. And then the activity, it could be direct labor hours, it could be the number of units produced. It just depends on how we calculate that predetermined overhead rate. I want to go back because I forgot to note that we get these standards from our engineers, from our accountants, from our HR personnel, from the people that order the goods for us, from our purchasing department. So it's not just a number in terms of, oh, this is what we want to pay and we dreamed it up. No, these are researched numbers that are backed by evidence. So here we have an example of a standard cost card. And I don't know, oh yeah, we're making bets. I was about to say, I don't know what we're making, but we're making bets. And in this example, of course, in order to make the bets, we need materials, labor, and overhead. There's a standard amount of materials that we need. There's a standard amount of hours. So this is how long it takes our employees to make one bet. And overhead is applied using labor hours. So we're using the same number here. And then we have the standard cost per unit. So for materials, that's $25 per kilogram. And then we have our wage rate. This is what we plan to pay based on our predetermined set figures. And this is the predetermined overhead rate based on those preset figures. Now, this part I'm going to skip because we can do overall cost variances, but they become more valuable to us when we can drill them down even further. And I'm going to show you what I'm talking about here. And this is actually what I'm talking about. So this is the table or the formula that we are going to use to help us calculate variances for materials, labor, and overhead. Let's just deal with materials first. Materials has two variances. It could be a price variance or it could be a quantity variance. And then there is an overall variance for materials. And when I say variance, I mean I'm looking at the primary overall difference between actual numbers versus standard. But to find the price variance, I isolate these items to only focus on what's different. So if you take a look at here, take a look at this. In this schedule, what we're doing is we're taking the actual price and we're multiplying it times the actual quantity. And then we're taking the standard price and we're again multiplying it times the actual quantity. And we're going to subtract these two resulting figures. And that's going to give me my price variance. In other words, that's going to explain to me what portion of my variance was caused by a difference between what I planned to pay and what I actually paid. We can further isolate this by looking at quantity. So now look at what's in common here. Now I have standard price for both of these, but quantity is what is changing, actual quantity versus standard quantity. And again, we're going to subtract this number from this number. And that's going to tell me what portion of my overall difference was because we use more than what we plan to use. We can say the same thing for labor. Either I pay them more than what I plan to pay them per hour, or they work longer than what I planned for them to work. Now for overhead, it's based on how we compute that predetermined overhead rate, whether it's based on units or whether it's based on direct labor hours. Now, this is what I was talking about earlier when I said the algebraic equation. If you want to use the algebraic equation to find the price variance, some people like that better. It's easier for them to just fill in the equation. By all means, use that. I like to use the table because you get to see the entire picture. Now, you're going to see this again if you are an accounting major or if you are a BAT major when you get to cost accounting. And when you get to cost accounting, you will get partial information and you'll have to fill in what's missing. So you'll find that the table is more helpful than these algebraic formulas here. So learn both if you're an accounting and a BAT major. Now, let's compute some materials and labor variances. All right, this is the point where I need my whiteboard, but I want to give you the page number because we're going to be looking at this same information from the book. And we, in a second, when I change my view here, you'll actually be able to see the board, but my slide, PowerPoint slide with the numbers on it, will not be directly in front of you. So of course, because I'm looking for this, I can't find it. All right, this is in your textbook on page 874. Is it 874? All right, page 87, actually it's the top of page 873. And on to page 874 is what we will be using. All right, we're going to be flipping back and forth here between the slides. But this is the slide that you need to, if you have your phone, take a picture of it because we are going to compute materials variances here. So during May, GMAX produced 3,500 club heads using 1,800 pounds of material. GMAX paid $21 per pound for the materials, and we need to compute the materials price and quantity variances. So the information that I need from this slide is down here where I have my standards. So this information down here is my standards specifically for materials. I need to know that it takes a half a pound of materials per unit, and I expect to pay $20 per pound. This $10 here is irrelevant. Do not pay attention to that. We need to know the cost per pound of materials, and we need to know the number of pounds of materials needed to make 1 unit of product. All right, let's switch to the screen here. Now, in order to recreate that table on the test, again, you can use your books, your notes, so you'll have the advantage of not having to memorize it. But I do have a way to help myself memorize it. Now, as I write these letters on this board here, it's going to form a word. Do not say the word out loud. Don't curse. But in order to perform cost variance analysis, and that's what all of this is, with standard costing, we're trying to find our variances, so this is called cost variance analysis. In order to perform cost variance analysis, the first thing I need is a donkey. Yes, I said it correctly, a donkey. All right. The next thing I need to do is rearrange my letters just a little bit. Now, the last piece I need are P's and Q's. So P, Q, P, Q, P, and Q. Now, I need to determine my actual price, my actual quantity, my standard price, and my standard quantity. And then we're going to fill it into this table. So at the bottom here, I like to make a little legend to help me remember what I'm looking for. So I have actual price, actual quantity, standard price, and standard quantity. So to find my actual price, this is the actual price per pound that I paid for the materials here. And in my example, if you look back at the slide, at the picture that you took, the actual price per pound was 21. The actual quantity was 1,800. Now that was $21. This is 1,800 pounds. The standard price, and looking again at that slide, and I'm going to see if I can bounce back to the slide just for a quick second so I can point out to you where I'm getting all this stuff from. So bear with me. So the $21 is what they paid. They used 1,800 pounds of material. And now I'm on standard price. The standard price is $20 per pound. That comes from that yellow table there. Now, standard quantity. I always like to put a star beside standard quantity because there is some additional work that I have to do. Because I want to make sure I'm comparing apples with apples and oranges with oranges. So let's take a look at this for a second. So I have the half a pound as my standard quantity. So 0.5. Now, I am supposed to be comparing actual price with standard price, actual quantity with standard quantity. What does this really mean? When it came to materials, because I'm making club heads, when it came to materials, I wanted to pay $20 per pound, but I ended up paying $21 per pound. Now, I paid more than what I planned to pay, but that does seem reasonable. In terms of how much I was going to use for quantity, I planned to pay, I don't know because that's my standard, or I plan to use, a half a pound, but I actually used 1,800 pounds. So in looking at that, and let me take you back to my screen here, and looking at that, that doesn't make much sense. If I planned for half a pound, and I actually use 1,800 pounds, somebody is out of their mind, right? So for standard quantity, I have to convert it. This is the standard amount for 1 unit. I actually produced 3,500 clubs. So if you go back to that slide, you'll see that we produced 3,500. So in theory, I have to multiply that half a pound times the actual number of units produced to determine my standard quantity. So when I do that, all right, so 1,750 is my magic number here. So now in comparing the actual quantity with the standard quantity, that makes a little more sense. What's my point here? I'm trying to fill in the missing pieces on this table. Actual price, actual quantity, and standard price are usually pretty straightforward. Not always, but generally they are straightforward. But with standard quantity, a lot of times it will require the extra step of taking that standard quantity per unit and multiplying it times the actual number of units produced. So now let's fill out our table here. So we're going to take this actual price of $21 and we're going to multiply it times the actual quantity of 1,800. We're going to take the standard price of 20 and multiply it times the actual quantity of 1,800. Then we're going to take the standard of 20 and multiply it times the standard quantity of 1,750. Now, once we fill in all of our numbers here, I'll show you what we're going to do. So the 21 times the 1,800 gives me 37,800. And then the middle one will give me 36,000. And then the last one gives me 35,000. The difference between these two numbers gives me what is known as the price variance. The difference between these two numbers, and I wrote my legend up too high here, gives me what's known as the quantity variance. But when you find the difference, you have to be very careful with how you're subtracting. You want to make sure that you're subtracting the normal way, in the normal way that you learn how to subtract. So you take this minus this, and then the 36 minus the 35. That's how we're going to determine whether or not these variances are favorable or unfavorable. So I'm going to take the difference between the 36,000 and the 37,800, and by subtracting in order here, I get 1,800, and the number is positive. So I want to make sure I keep up with my positives and negatives here. And again, when I do this one, the 36 minus the 35,000, the number is positive. Here's the deal. When the number is positive, the variance is said to be unfavorable. So I put a U beside it because it is unfavorable. And this chapter is a little bit weird in that you may look at it and say, but it's positive. Positive is supposed to be good, but not from the standpoint of us spending too much money. These are cost variances. So if I spent more than what I planned to spend, then I overspent. That's going to give me a positive number, but it's unfavorable. If I spent less than what I planned to spend, that's going to give me a negative number, but it is favorable. That will make that variance favorable. So now let's take a step back and let's look at this using our common sense perspective. Because we calculated the price variance, which means we paid too much per pound. We paid more per pound than what we planned to. So when all this is done, these are all dollar figures once we multiply out here. So in terms of the price variance, I planned to pay 20. That was my standard. I actually ended up paying 21. I paid $1 more than what I planned to pay per pound. And what was the pounds that I was dealing with? The 1,800. That's why my price variance is 1,800 here. For quantity variance, I only needed 1,750 in terms of pounds, but I actually ended up using 1,800 in terms of pounds. So from looking at it from that perspective, I use more than what I plan to use. It is unfavorable. Now let's get to the fun part of this. Let's see if I can go back and share the slides with you, because the fun part of this is explaining where all of these variances came from. So we sort of get to play the blame game. All right, here it is all nice and neat on the slide. I guess I could have just showed you on the slides here. But who's responsible for these variances? Now, I can combine the 1,800 variance and the 1,000 variance, and then that will give me the overall materials cost variance. But the question is, who is responsible? And it's easier for me to be able to tell who is responsible when I have things from the perspective of price versus quantity. So you'll have one person in one department saying, it was the price variance. That's the real reason for the materials variance here. We ended up paying too much because they didn't put my order in on time. Or they purchased cheap materials, so we ended up using too much. So every time I put the materials in the machine, it didn't work. So we can blame it all on the purchasing department if we're the production department. Then the purchasing department can come back and say, no, production people, it's you, because you don't know how to supervise your people. You didn't tell them how to use the materials properly, so they ended up wasting it, and you had to keep ordering more, and they used too much. And not just that, you don't know how to schedule your jobs. So when you schedule your jobs, you don't have your materials in time. We have to do a rush order, and they upcharge us on the rush order, so that's why we paid too much. So it can always become a blame game, but this is why we break out those variances in terms of price versus quantity. Now, let's see this with labor. With labor, your book likes to switch to actual hours instead of actual quantity. I still like to use P's and Q's so that it doesn't confuse me. P refers to price. Q refers to quantity. It's just that when I'm dealing with labor, the quantity is hours. When I'm dealing with labor, the price is the rate. That's all. Now let's skip to this slide here. Let's go to the next slide, and let's do this from a labor standpoint. So we have that slide giving us all that we need And I like to erase the entire thing to help me memorize the table. And I usually don't tell you to memorize, but this time I do want you to memorize. All right, it's hard for you to see, but I'll minimize my screen in a second. When doing cost variance analysis for labor, it looks very similar to cost variance analysis for materials. So I still need the same thing. I need a donkey first. Let me get my donkey. Now, then I rearrange my letters a bit to A, S, and finally I need P's and Q's. Then I create my legend. Of course I messed up. All right, once I get the information from this slide, then I'll switch back. So in terms of the actual price here, I'm focusing on labor, and we're told that, again, they produce 3,500 club heads working 3,400 hours. That 3,400 hours is my actual quantity. We paid our employees an average of $16.50. That's my actual price. In terms of my standards, this is when I have to come down to my yellow table. Ignore the number, the totals here. We're looking at the numbers in parentheses. So for labor, the rate, the standard rate, it's 16. Put my dollar signs so I don't confuse myself. And this is hours. But for standard quantity, I have 1. Does 1 hour compare to 3,400 hours? Let me stop sharing the screen so you can see. There you go. Does 1 hour compare to 3,400 hours? Absolutely not. For standard quantity, this is the one where you need to do a little bit of extra work and multiply that times the actual number of club heads produced, which was 3,500. So I'm dealing with 3,500 hours. Now, just a quick look at this, I can tell already which variances will be favorable and which variances will be unfavorable. I plan to pay 16. I ended up paying $16.50. Not happy with that. I paid out more than what I planned. In terms of how long these people worked, I planned for them to work 3,500 hours. Oh, they only did it in 3,400. So I'm expecting that to be a favorable variance. Now, let's fill in these numbers on our table here. So AP times AQ, and then SP times AQ, and then SP times SQ. Now, when we fill in our totals, 56,100 and 54,400 and 56,000. We still have to subtract in the proper manner. So it's this number minus this number, and then this number minus this number. So I take 56,100 and I subtract the 54,400. I get a positive number, and that means that that variance is unfavorable of 1,700. And this is called my rate variance. And it's unfavorable. Now, when I subtract these two, I get a negative number, and it is negative 1,600. So that means it's favorable. Now, is it necessary to put the negative? No, you don't have to put the negative, but I like to put the negative because it helps me remember that this variance is favorable. This one is known as the efficiency variance. What this means, even though this is in dollars, I'm all over the place here. Down here, down here. Even though this is in dollars, this means that my people worked for less time than what I planned for them to do. But this one means that I paid them more. Now, let's see this all nice and neat on the slides again. Because the important thing is explaining why we have these rate and efficiency variances. So I'm going to show you this all nice and neat on the slide. Come on, slide. All nice and neat on the slide. And I can combine the 1700 and the 1600 to determine the overall cost variance. But who's to blame for this? So in this situation, we paid a higher rate to get the work done faster. So this could possibly mean that we have higher skilled workers doing unskilled tasks. They'll finish it faster because they're just used to, their skill level is so high that it doesn't take them long to do low skilled tasks. They'll finish it faster, but you have to end up paying them more. So that's a balancing act. Do you really want your high skilled workers doing low skilled tasks? Yes, they finish faster, but you have to end up paying them more. And when you look at the overall variance here, the overall variance does end up being unfavorable. So who's to blame for this? Again, you have your department heads fighting with each other. So you could have your HR person saying, you know what, you don't supervise your employees well. Your people are playing in the bathrooms and not getting their work done. So it's taking them too long to work when you have a large unfavorable efficiency variance. Or it could be the production manager saying, you know, you keep ordering these cheap materials to the purchasing manager, and it's making my employees have to work longer. The material gets stuck in the machine breaks down, we're wasting time, and then I have to end up paying them overtime because all those people were standing around with nothing to do, and by the time the machines come back online, I have to pay them overtime to get them to finish the job. So with all of these, yes, we find the variances, but we want to determine who to blame. Now, I just told you in the budgeting chapter that you should not use a budget as a disciplinary tool for employees. So I'm saying we're trying to find out who to beat over the head, but I really mean what department do we need to focus on so that we can make improvements. Don't see it in a negative light. Now, we can also do this same thing for labor. Not labor, excuse me, overhead. Now, I don't like the way your book presents the overhead variances until we get to the appendix. So this is what I want to focus on right here for the appendix. We're still using this same format. But for overhead, because there's a fixed component and a variable component, the variable component looks just like what we just did for labor and materials. But the fixed overhead component looks a tiny bit different because for fixed, we're looking at the budgeted amount versus the actual amount versus the applied amount. And what is applied and what is budgeted are two different figures because the budget could be based on the flexible budget numbers, but the applied amount is based on the actual number of units produced. Here's the important thing I want you to remember about the overhead variances. There are what we can call or combine and call a controllable variance, and then there is the volume variance. The volume variance is the non-controllable variance. This one only happens because the amount of units we plan to produce is different from what we actually produce. That's it. So when it comes to controlling overhead costs, we need to really focus on all of the variable overhead variances and the fixed overhead spending variance. The volume variance we ignore. So we combine the two overhead variances and the fixed overhead spending variance to determine what's known as the controllable variance. So in using the same numbers that we were dealing with before, my slide is a little crazy here. We'll go back. This is the calculation for variable overhead and fixed overhead for these variances here. So for fixed, that's the one that I told you was different. Variable, I'm going to show you that when we do a problem in a second. But for variable, looks the same as labor and materials. Fixed, we have 3 categories of actual, budgeted, and applied. So there's actually less multiplying. Then we find the difference between actual and budgeted to determine the spending variance. And we find the difference between budgeted and applied to determine the volume variance. All right, I'm not making you responsible for the entries for this chapter. So that ends the slides. Let's look at one big problem together. And then we'll be done for the entire semester.